Our banks, I talk to a lot of people, and no matter who you seem to talk to, nobody feels sorry for our banks. They make billions of dollars every quarter. They charge fees for, certain types of accounts. So that if your account goes into a negative balance, you get hit with a cost. If you want to have some checks produced, there's a fee for that. There are a lot of fees that the banks charge. So I don't think anybody feels bad when they hear that one of our major banks didn't make as much money this quarter as they made that last quarter. But one of the main ways, or most important ways, that our banks make money, our banks in the US, banks around the world, is through net interest margin. Now, what is net interest margin? Simply put, net interest margin is basically the money that a bank makes, and it's the difference between what a bank pays out on the money they have sitting in savings. So if you put money with a bank savings account, what interest rate are they paying you? Are they paying you 1%, 0.5%, etc.? And it's the difference between that and what they charge you for the loans they provide. So if you have a mortgage, are they charging you 5.5%, 6.5%? And the spread between the two is called net interest margin. And we have a chart about this that we can show. And I think it's the most powerful chart in our show today. And it clearly shows the difference between what a bank is paying and what they're charging. And you can clearly see here, if you take a look at, for example, TD Bank, they're charging on their 5-year fixed mortgage rates 5.5%, but they're only paying 0.5% on interest savings accounts. They're charging 6.5% on variable rate mortgages, but they're only giving you 0.5 point for money you have in a savings account. Scroll down, you see other banks are paying a little bit higher. It looks like the highest one is BMO, paying 1.8%. But again, on a variable rate mortgage, you're looking at 6.5% interest. So you can see how much money the banks are making in net interest margin. Now, when interest rates go higher, we always like to say banks make more money, and it is true because of this reason. Unfortunately for the banks, they lose out in a lot of other areas. Perhaps people aren't as quick to take out loans when they're paying 6.5% interest. Perhaps trading is not going as well. Wealth management division, managing money, managing portfolios. Portfolios may fall when interest rates are rising, when the stock market is falling. So banks, they charge a flat fee for certain types of accounts that they manage. So obviously, if those portfolios, the value of those portfolios is falling, then they're not making as much money in wealth management fees. So they don't make money in every aspect when interest rates go higher. But you can clearly see by the chart we had up that these banks, top 5 largest, smaller banks, banks in Europe, banks in the United States, everybody makes the same profit based on what they pay and what they charge. And that spread is called net interest margin. So I thought it was quite interesting that everybody understand that the banks are doing just fine. They may not be increasing profitability when times are tough and the economy is not doing as well, but they're doing all right, I can safely say. And yes, I know most people will say, I don't feel bad for them, and I don't either. But at the end of the day, the best way, in my opinion, to profit from how the banks are profiting from us is owning a bank stock. Why not own stock in a large bank here in Canada, such as Scotiabank, making 6% dividends just for owning the stock, or CIBC, or TD that pays well over 4%. How can you make back some of the money we're paying the banks? Own the banks. So you share in their profitability. And I think that is a better way to look at it than just sitting back and saying these banks are making way too much money.